Explain 5 objectives of performing analytical procedures as part of audit risk assessment. Objectives of performing analytical procedures in risk assessment. I'll give a new one answer there. One objective is to identify significant risks. I gave you an example of techniques we use in analytical procedures is maybe calculating ratios. Different ratios could be liquidity ratios or trend analysis or any other ratio. Okay? So analytical procedures can help auditors to identify significant risks that may affect the financial statements. And by comparing the client's financial data to, say, expected results, or comparing a company's financial data to industry benchmarks, auditors can identify unusual fluctuations or trends that may indicate material misstatements. So if a company has, say, a budget that is expected results, budgeted financial statement or income statement. If the budgeted income statement, the company is expected to, say, generate 10 million shillings as a net profit, but the company ends up generating, say, 1 million. When this is compared, this is what is expected, but this is what was reported. That shows that there is a problem, significant one, because this difference is abnormal. The company was expected to earn 10 million, has only earned 1 million. That is an indicator that there could be significant risks or errors. So by comparing the client's financial data to expected results like the budgets, the forecasts, or to industry benchmarks. Industries have benchmarks. So if there is a huge deviation from what is expected in performance of companies in that industry, if there is a huge deviation or fluctuation from the standard, then that may indicate the presence of, it may indicate potential misstatements. That's one objective, to identify significant risks. The second objective is that analytical procedures enhance understanding of the business. Enhances understanding of the business. Analytical procedures can provide auditors with a better understanding of the client's business and industry, which can help them identify relevant risks and also to assess the appropriateness of the client's accounting policies. Another objective is to assess the reasonableness of the reported amounts or recorded amounts. Analytical procedures can aid or can be used to assess the reasonableness of the recorded amounts in the financial statements. Because by comparing the client's financial data to expected results or to industry benchmarks, the auditors can identify any unusual or unexpected fluctuations that may indicate potential misstatements. Another objective is to identify potential misstatements. Is to identify potential misstatements. They can help auditors to identify potential misstatements in the financial statements because by comparing, again, the expected fluctuations, by comparing the expected unexpected fluctuations, by comparing the unexpected fluctuations or trends, auditors can investigate further to determine whether there are underlying errors or misstatements. You understand? And you can see that this my points here. I've been supporting them with I've been supporting the statements with comparison of the expected and actual. Expected and actual. That will help you understand the role of analytical procedures in risk assessment. So how many points are we required to give? 5. Now the fifth objective of analytical procedures is that they provide evidence of reasonableness, provide evidence of reasonableness of financial statements. Analytical procedures can provide evidence of the reasonableness of the financial statements because by identifying and investigating any unusual fluctuations or trends, auditors can obtain evidence to support their conclusions about the fairness of the financial statements.